All right, everybody. How are you doing today? So we got good audio and video for everybody out there. You can hear and see what's going on. All right. Well, I want to go ahead and get started, and we're going to talk today in this Nadex application and strategy webinar series about picking the right spread, the spread options. And before we get started, as always, we're going to go ahead and go into the disclosures. Trading futures, options, also swaps involve risk, may not be suitable for every investor. And this is education. You make your decisions, and you make your decisions and what you're going to do from there. Okay. So with Nadex, one of the things you're going to notice between these two disclosures is on the Nadex disclosure, it doesn't say you can lose more than what you put up, but on futures and forex you can. And so that's one of the really nice things about Nadex is, your risk is capped on every trade. Doesn't mean you have to risk all the risk you put up. You can decide to get up, but your risk is capped and it won't get any worse no matter what happens. Apex Investing is the organization, and our motto is traders helping traders. And we're education based. We have over 25,000 members. We've been, in business for, about 8-9 years now. We're focusing on, we focus a lot on risk management. We focus a lot on probability, and we're traders just like you are. We're also a Nadex educational partner, where they allow us to come on and do webinars, and because they've, liked the content that we provided. And my name is Darrell Martin. I'm a full-time day trader since 2008. I've traded on Nadex for over 7 years. I've traded for over 15 years. I founded apexinvesting.com and have developed a lot of free tools for Nadex traders that are completely unique. And I'm a trader just like you. I'm not some guy that went to get a master's in finance. I have some degrees, but they're not anything to do with math related. And I trade out of my house. And I trade full-time, and I trade Nadex options on a daily basis. So, I've learned a lot, obviously, doing that over 7 years. And, I've learned a lot helping a lot of traders over that time. So, I look forward to, helping you out as well. One of the things I'd like to do is hand the mic over to John Skelton, who's on with me as well. And he has a lot of experience, right-hand man at Apex. And go ahead and let him talk to you about, picking the right spread. And then some really unique concepts he's come up with that make a lot of sense, converting binaries to spreads to help you understand a few things. And then I'll come back in and add in a couple pieces as well. So you want to go ahead and take over there, John? Let's see if he's on and can do that.
All right, yeah.
Yeah, okay.
I can do that. Give me just one quick second here. Hey, guys. How's everybody doing today? Can you just confirm, everybody, we coming through loud and clear here? Can y'all hear me and see me here? See the screen. Let's see here. Just make sure we're showing the right screen here. All right. Thank you, Star. I appreciate that. All right, guys. Well, again, as Darrell just mentioned, we're going to talk to you a little about spreads today and picking the right spread. I know that, some of you have been on with us before, and as you might be familiar with, with us doing these Nadex application and strategy webinars, what we're here for, like Darrell said, is we're traders just like you. We're here to provide you with, some information about who and what is Nadex, how you can take advantage of the Nadex products and implement them into your own trading. And just real quick, for some of you that might be brand new with us here today, and if any of these concepts we're talking about today are maybe a little bit over your head, I just want to direct you back over here real quick to, if you just go over to nadex.com, you can go through some of these top tabs right here and get some general information. Okay, basically Nadex offers two different products. They offer binary options and spread options, and you can go through these two tabs here, get some basic information about what those are. Okay, and if you might have missed some of our past webinars, if you hop right over here to Learning Center, something I've got to give Nadex a lot of credit for is they do a great job for their members, providing them with tons of free tools, tons of free education. And if you go right here, if you go to webinars, click this, this will show you some of the upcoming webinars. That way you can know, what are some of the subjects coming up in the future, date and time. You can get registered for those webinars. You'll also get reminder emails that they're coming up, okay? You've also got some great information in here as far as different videos, trade examples, and so on. But if you click webinars right here, and this again will show you the schedule of upcoming webinars. But right here, if you click on demand, and then just come down right here and find me or Darrell right here under Apex Investing Institute, okay? This is kind of an on-demand library here where all of the webinar recordings are placed. Today's webinar is being recorded as well. This is where you can find them. So if you're brand new and you're just starting off, there's a great place to go and check out some information here. We kind of start, with the basics, with the foundation. You can see right here, Nadex Binaries 101. Or today, for example, we're talking about spreads. We're talking about how to pick the right spread. Well, some of you might still be saying, hey, some of this information's over my head. I don't even know what a spread is. Well, right here, basics of Nadex Spreads, okay? This is where we kind of just hold your hand and kind of walk you through what is a spread and how does it work, okay? So, and then we kind of build from there. We go into different strategies and systems and ways to trade at night and different things there. So check that out. It's a great place there. To get caught up on anything you might have missed or anything that might be a little bit over your head here, okay? For those of you, so we're not going to really spend a whole lot of time today covering the basics, all right? But for those of you that might feel like you have a basic understanding of what spreads are, but maybe you've tried them and maybe they haven't quite worked out for you the way that you thought they should, and you're wondering why that is. Okay, let's talk about that for just a minute, because I know that several of you are familiar with Nadex binaries, okay, but you're just starting to dive into Nadex spreads and, having a good understanding that, there are some differences there, okay? And what I'm going to do here is I'm going to just real quickly pull up the Nadex demo platform, okay? And I want to do a little quick quiz here, all right? Nadex binaries and Nadex spreads work very differently, but some of you have a decent handle on Nadex binaries. So I want to just pull something up here. I'm going to pull up some Dow, some Wall Street 30 binaries here. Now, if those of you that are familiar with binaries, you understand that at expiration, a binary is either worth 0 or 100. Okay? So a lot of you understand that. So as an example, if I were to buy, let's just say this binary right here. Now guys, keep in mind, this is the Nadex demo platform. I'm simply going through this platform and through these order tickets and examples as an example to help you see and visualize what we're trying to teach you today on this webinar. This is in no way, a trade recommendation or trading advice whatsoever. Okay, keep that in mind. But as an example, if I were to, buy this binary right here, okay, and let's say I was to buy it for, $26, right? Okay, or let's just say, yeah, this one right here. I was to buy it for about $26. At expiration, what would it be worth? What's the most it could be worth? Who can tell me? Well, if I was to buy it for around 25, 26 bucks, the most it would be worth is $100, right? So let's say my strategy or system, my charts, my indicators, whatever system I'm using is telling me, hey, there's a bias for the market to go up. And let's say I bought this binary right here, for about 25 bucks. And let's say that the market went up, okay, or let's say I even bought this one right here for about 40 bucks. Let's say the market went up 20 points, okay? And that binary was worth $100 at expiration. How much would I approximately make on that 20-point move? Well, if I bought it for 40 and expired at worth 100, I would have made $60 off that 20-point move, correct? Now, what if I were to come in here and buy this one instead? Okay, and I bought this one here for about $60. All right, and the market made that same 20-tick move. Okay. Well, the binary would expire and be worth $100, correct? So I would still make $60, right? Just like I made on the other one. Who can tell me? Market makes the same 20-point move. Both binaries expire worth $100. One of them I bought for $40. Therefore, I profited $60. The other one I bought at $60. So how much did I make on that one? Did I make the same amount or did I make less? Right, so I made less. Now, what if I went in and I bought this one at about $83, $84? The market makes that same 20-tick move, expires worth $100. How much did I make on that one? Did I make 60 like the first one or 40 like the second one? No, I'd make, about $15, $16, right? Okay, well, I'm trading a binary. So on all three of those examples, I'm trading the same product, instrument. The market made the same 20-tick move. Why did I make a different amount on those different binaries? How come not every binary is going to be the same for me? I mean, hey, the same market, they're all binaries. The market moved 20 ticks. Why would I have made a different amount on each one? Well, it's a pretty simple answer, right? It seems very elementary to you, right? It's like, well, hey, the most it can be worth is 100. You bought one at 40, different one at 60, different one at 85. That only makes sense. Everybody agree? Very elementary concept of why my profit would have been different on each one. Okay? So for those of you, example. Okay? It's different strike prices. I bought at a different price. Okay? So that makes sense. So now that you guys that have a basic binary understanding, you can see that and you're like, okay, John, why are you talking about that? Like, that's elementary. Everyone gets that. I bought it at a different price. Okay, but notice in each one of those examples, what's the one thing I kept repeating that the market did? I bought this one, the market went up 20 points. Or I bought this one, the market went up the same 20 points. Or I bought this one, it went up the same 20 points. You understand why you had a different profit amount on that same 20-point move, okay? But then I've talked to some of you guys that said, hey, now I'm diving into these spreads, okay? And I'm really wanting to learn these spreads. And I was on this webinar, with John or Darrell, and they taught me the basics about how spreads are not like binaries. They're not all or nothing. Spreads are $1 a tick. But, what I don't understand is I was trading my strategy or system, and my strategy or system told me, hey, I think the market's going long. So I bought a spread, and after I pressed enter on that spread, the market was right here at 18.15. It went up 20 pips. So based on that webinar that guy did, I should have made $20 because it's $1 a tick, right? But my P&L or my account balance only went up like $8 to $12. Forget it. I don't like these spreads. These spreads don't work. That guy on that webinar didn't teach me right because he said $1 a tick. I got in, it went up 20 pips. I should have made 20 bucks. Spreads don't work. Has anybody had that experience? Whether now or whether when you first started playing with spreads, have you ever had that experience where you got in and it didn't make sense to you why you did not make more on that spread? Show of hands, who can say they've had that situation happen to them before with spreads? Anyone? Store says, hey, I'm still learning. Okay. Well, I think many of you have had that situation happen. And I have to admit, when I was first learning spreads, I had that situation happen a little bit. Okay. Now, let me talk to you real quick about why that's happening to you. all right? And I can pretty much tell you exactly what you did, okay? So what you did is you were saying, hey, I'm gonna try out these spreads. And what you did is you went in and you pulled up some spreads, right? And you were looking at, you know, whatever market it is you were looking at, okay? I'm just gonna randomly choose one here, okay? And, you know, what you were doing is you're saying, okay, I wanna look at buying some spreads here. I wanna try out this spread thing. And, well, there's quite a few here. There's several to choose from. There's different floors and ceilings. And, you know, I'm gonna randomly just choose this one. And I wanna say that I want to buy it, okay? Or, you know, yeah, I wanna buy it. Oh, look, max loss $81. Okay, well, all right, what about these, you know, daily spreads? What about these ones here? Let me try something different. Let me choose this one right here. I wanna buy, whoa, max loss $3.99. Or, you know, well, okay, what about this one right here? And you're clicking, you're going, oh, max loss 249. I don't like that, right? You're saying, oh, I don't like that. You're getting scared away, okay? And then what you're doing is you're coming back here and you're saying, well, what about this one right here? You're just randomly, oh, max loss, 14 bucks. Oh, I like that. I'll take that one, right? That's what you're doing. You're choosing your spread based on that price, right?
And John, I want to bring up it's so common that I mean, we're always thinking about we want less risk, right?
Absolutely.
And so it really is just a natural. It's not that you're unique or alone. It's it seems to make sense. It's like, hey, it's only a $14 risk on this trade. It moves at $1 a tick. So why would I ever choose one that's a higher max risk? So, and then, but if you take that concept and you apply it to like what we just talked about on, you know, binaries, you wouldn't simply choose a binary based on low risk, because just because a binary is low risk, it may be so far out of the money, like so far above the contract that it doesn't even make sense to get into the contract. And so
Absolutely.
risk really isn't it almost sounds counterintuitive, but risk itself is actually not the way that you choose the best contract, whether it be a binary or a spread. So one of the things you have to understand is that these are option contracts. And I want to say that again. These are option contracts. They are not futures. They are not forex. They're not commodities. They are option contracts. And why do I keep saying they are option contracts? Well, one, because you have options, okay? And if you have options, that means there are different choices. And as obvious as that sounds, risk is not the only difference between those choices. How that contract moves, how much money that contract can make, and you know, several other factors that come into play, but the biggest one on the spreads is, and this is where you're going next, John, is where the price of the spread is. So, you know, we can talk about that same 20-tick move, but we have to look at where the price of the spread is, just like we have to look at where the strike is, not simply the risk of the binary option, not simply the risk of the spread option, but, you know, where's just like on a binary, you look at where's the strike. On a spread, you're going to look at where is the price, okay? And by what I mean by that is right now it's quoting at, this contract example John has up is 25,301 per bid, and the offer is 25,305. But the underlying market, okay, which means the actual Dow, you know, contract, the indicative price that Nadex puts up there for you, is 25,246, 245. You know, it's fluctuating there. So compare the offer with the indicative, and look at how 25,304 is higher than 25,245. Quite a bit higher, right? I mean, you're talking about buying So what is that right there? I mean, if we do the math on there, we got what?
About
25,
50, about 60, about 60.
Yeah, literally 60 ticks right now. You're
Yeah, I think we lost Darrell's audio there for a second, but does that make sense what he's trying to explain to you there? Okay, let's look at it on a little bit different level. Darrell, I think we lost your audio. Just let me know when you pop back on here. Let's take a look at this chart that I had up here a second ago. Okay, look at this euro dollar chart. All right, now where is the market at right now? About 18.15. Okay, so let's just pop up. Let's just look at this on a a smaller scale real quick here, and let's pull up some forex spreads. Let's go to euro dollar. Let's take a look at 3 p.m. here. Okay, take a look here. Look at we got the offer side showing us the price we can buy for. Okay, and then we've got the bid side price we can sell for. Right now, notice. Okay, you can see right here the indicatives at 18.14. But look at where we can buy. Look at the different options here. Okay, so we've got what? 18.22, 18.16, and 18.05.
So that comes back to where I was talking about looking at where the price is on a spread. Like you look at where the strike is on a binary, you look at where the price is on the spread itself. Because notice he's saying 1822, 1816, 1805, but now we want to compare that to the market. So go ahead and pull up that chart and display that, the boxes and everything.
All right, so let's do this. All right, so right here we've got 21, 15, and 05, right? So let's just say, you've heard me say this before, with spread options, I like to call them like box spreads, right? Because you draw them on a chart, they look like a box, as it were, okay? You've got your floors and your ceilings. So right now the market's at 18.14. So we've got one option. Let's go over here closer to the prices so you can kind of visualize this a little better. So let me do this here. Now, so what do we've got? We can buy one at 18.21. So up here, right? 18.21. We can buy one at 18.16, about right here. Okay, and we can buy one at 18.05, about down here. So those are the 3 different choices. You see that again? Okay. So imagine this being what we were showing you earlier, all right, with binaries and different strike prices. And how many of you have said, well, my chart told me to go, my system told me to go long, and when I pressed enter and bought that spread, the market was at 18.14. So then the market went up 20 ticks, right, to 18.33 up here. Why did I not make $20? Because the market moved 20 pips from when I got in to where it was now. Darrell, you want to take it from there?
Yeah, so when you got in, the underlying market was at 18.14, but you bought up at 18.21. So you bought above the market. You gave up basically 7 ticks of profit potential out of that 20-tick move. So when it rose up and rose up and rose up and went through that price, and finally got up there to 18.34.
Yeah.
Look at the difference between 18.34 and that top blue line, that blue arrow that John drew. Versus look at the difference between the orange line, where the wide market is, and 18.34. See how large that difference is versus how small that difference is? So since you bought, remember I said, one of the things I kept saying is you have options, and the important thing on spreads is to pay attention to the price there's a lot of things that you need to look at. But the first thing you need to look at is where is the price of the spread in relation to the underlying market. or even the indicative index, which you can see right on the ticket. So I want to make sure that I'm, if it's way up there, it doesn't mean that it's a bad spread to trade, okay? Like it could be a great spread even though it's up there. Maybe it's low risk and you're expecting a large move. But what you don't want to do is get in that spread and wonder why did it only move, like 12 ticks whenever the market moved 20 ticks. You want to understand why it didn't move that far, why it bought higher. So if I do get a 20 tick move, the most I would expect is like a 12 tick profit to be up on that trade because I bought higher than the market. And once you start to understand that concept, then spreads start becoming easier because you're intentionally picking the spread like right where the market is because you want it to mirror the market. Or you're going, hey, I know this is a lower risk spread, and I know I'm buying higher than the market. Just like, I made a switch to buy an out of the money binary, if I trade binaries, but I'm doing it on purpose. I understand it, and I understand that, the movement that has to occur before I really start seeing the contract move quickly in my favor. And that I don't expect to capture the full move because, how can you buy 8 ticks higher than where the market's currently at and expect to make much between that now and that 8 ticks? But, once it passes that, I would expect to, make some money. And there's a lot of concepts we can go into, but if you get that down, then you're actually on your path to understanding the spreads. And I'd say the one simple other piece I would add on, without trying to make anything complex, is once you understand that, then just make sure you have, like the idea is to make sure you have some profit potential. So you're not buying like right at the top of the box, right? So you wanted to understand where you're buying, why the contract's moving that price, and have some profit potential in there. And, John, why don't you talk about the risk versus the max risk, like planned risk versus max risk?
Right. And that's really what this boils down to is, one of the biggest reasons that, like in an example I showed you there, a moment ago was, the same concept with binaries. Like let's just pull this back up here, all right, on euro dollar. And again, for a newbie saying, okay, well, what if I was to buy this one right here? Oh man, my max loss is $71, okay? Compared to if I was to buy this one here, it's only 25 bucks, okay? Or if we, remember the example I showed you over here under the Dow, okay? Like on some of these, larger daily ones, when you're pulling up some of these, bigger number spreads, like 399 or, it's that because you're used to trading binaries. As soon as you see this max loss dollar amount here,
you're thinking all or nothing.
Yeah, you think, oh, all or nothing, like in a split second at expiration, boom, I'm going to lose $237. Forget that. I don't want to trade that one. Not at all. And that's when you're coming up here and finding this one, like, okay, $52, that's more like it. All right, I like that. Okay.
Well, the reality is the market would have to go against you, like on that previous example, 237 ticks for you to actually lose that. And that's 237 points on the Dow. It doesn't mean that can't happen, but it'd have to go against you that far, and you'd have to choose to stay in the trade the entire time and just ride it all the way down for you to actually lose that much. So, exactly. But if it just oscillates around, and let's say you buy and it goes down 10 ticks, then basically between where you got in and where it settled is what you're going to lose. It's not going to be an all or nothing. The only way it'd be, all is if it expired up all, but the underlying market went all the way above the ceiling. The only way it'd be a nothing is if from where you bought, the market went all the way down and expired below the floor. But if it expires anywhere between the floor and the ceiling, then your actual risk or profit is going to be the difference where you bought and got it out, or where you sold and got out. So just because that says $440 risk, we're talking about a 440-point move on the Dow, which, hey, can't happen. And the awesome thing about Nadex is it won't get any worse than that, okay? But it doesn't mean you can't use a little common sense or maybe combine some other spreads together to help you lower that risk. There's a lot of cool strategies that we teach to help you with that, more advanced strategies. But if it goes down 20 ticks and you want to get out and just lose $20, you can do that. You don't have to risk $80 or $400, or let's say lose $80 or $400. You can choose to get out of the contract. So I think that's just one of the most important things, because so many people, they revert back to choosing back on risk.
Right.
And it's like, what should you be looking at? Did we say you should be looking at risk? I said, make sure there's some profit potential in the trade. But the main thing you should be looking at is what is the price of the binary. So if I want to buy, the binary is priced right now at 25,220 versus what is the price of the indicative, and it's 25,212 right now.
Right. Yeah. The
so
spread. Yep.
Exactly, the spread. I'm sorry. So since the spread is, it's about 8 ticks above the market, which on the Dow, not a big deal at all. Okay. On FX right now, that's that can be quite a bit. But the Dow, it's moved 8 ticks since we've talked. I don't know how many times. It's moved 30 ticks in the last 10 minutes.
Yeah.
So 8 ticks isn't a big deal. But you go over and look at some of the other contracts, and one of them there you're buying up at 25.37.
Yep. This one up here. Mm-hmm.
Yeah.
That's getting you a much lower max loss number here. But yeah, look at the difference.
And so if you're expecting like an explosive move, and you're okay with buying 30, something ticks above the market, that could be a good contract for you. But it's going to be a horrible contract for you if you're trying to get in the market and get out 20 ticks later or 10 ticks later.
Right.
Like, that's not going to be the contract you want, because it's not going to move anywhere close to the market speed. So, and the same thing, this is something I think that's important to note, is there's also another contract on there that you can buy lower than where the market is right now. At 25,189.
Mm-hmm.
And on that contract, and it's just go ahead and click on the buy price there. And on that one, notice I said you want to make sure you have profit potential. Okay? So you look at that and you're like, wow, I can buy lower than where the market is. Like, if you could, isn't that great? Wouldn't you like to be able to buy lower than where the market is, like at any given moment? It's like, yeah, big money. But look at the profit potential on the trade. Okay? So again, I'm not even paying attention to the risk. Only the profit potential. I can only make like 12 or 15 bucks on this trade, and it goes to 415, and it could go way down. So yeah, it's lower than the market, and that's great. And there are some what's called premium collection strategies you can do with those trades. But especially when you're starting out and you're just trying to pick the right spread, that's not enough profit potential for me to do the trade. And if I buy it, and I think this is the important thing to get back to, if I buy that contract, I better be doing it on purpose, because I'm buying at a price way different than where the market is. And in this case, there's not a whole lot of money that can be made. I may say, well, I'd be happy with 20 bucks. Well, since you're buying it at a price way different where the market is, if the market moves up $20, you're not going to make $20, okay, in just the market movement. Time is going to have to pass, and it's going to have to expire there, okay? So the closer, and this is really what it comes down to, the closer the price, either the offer or bid if you're buying or selling, is to the indicative. So they sort of point to like where they can look at right at Nadex, they can look at the bid and offer, and they can look at the indicative. The closer the Nadex spread price is to the indicative price, the faster the contract's going to move. If there's very low risk, it's going to take a lot of time to make much. If there's if there's very low reward, if there's very low reward, it's like that 25, 180, whatever that we chose. It's going to take a lot of time to make that money. If there's very low risk, it's going to take more movement to be able to make money.
Right.
But if it's close to the price, then you're going to be, pretty close in lockstep with the market. So when it moves 20 ticks, you're going to move, approximately 20 ticks. Again, it's an option. So you would have it called optionality. And it's not anybody messing with you. It's an option contract. So that's how options work. It doesn't matter if you're trading them on Nadex, the CBOE, the CME, the New York Stock Exchange, anywhere. That's just how all options work.
Right.
So, but
like
people
here,
always consider the risk versus the price. Yeah. Yeah, you can buy below the market right now. Yeah.
Yeah, and you could buy right here close to the market.
Yep.
You know, so if you bought here and the market went up those 20 ticks, you know, you're going to be moving closer with where the market is now. You know, if you bought way up here, it's going to take some time for the market to get up there. You know, it just makes sense once you visualize that and realize it's not just about the floor and ceiling and having different options. There's a reason they're there, just like the different binary strikes are priced differently. You know, close to that. You know, if you kind of look at, if you kind of look at that in that same concept, it starts to make sense as you're making that switch from binaries to spreads. You know, and again, you know, if my strategy or system is telling me, hey, I want to go long, but you know, then the market moves down against me, you know, or even on the Dow, you know, if you look at that bigger picture we were looking at, you know, hey, right in here, I thought the market was going to go long, but hey, it ended up going down, you know, and it went down 20, 25 ticks against me. So maybe I'm going to get out now. So maybe I had to put up $300 out of my account to get in this trade, but hey, I was wrong. It didn't go up. It went down 20, 25, 30 ticks, whatever my, you know, strategy or system tells me my exit is. Hey, I can get out. You know, it went against me 30 ticks. I got out. It's $1 a tick. I'm down $30. Okay. So, you know, again, just because that max risk showed all the way down to 24,800, which, I mean, I have to just keep squeezing and squeezing my chart to even find 24,800. You know what I mean? Like, okay, there it is. I mean, if I'm wrong, if my strategy told me go, you know, right here, go up, I'm wrong, the market's going down. Am I really going to sit here and watch this thing go down against me? You know, 350 ticks? Or am I going to exit and manage my trade? And again, that's the beauty with Nadex. You don't have to hold anything until expiration. You can exit early. You know, so
or you can even combine other spreads together to lower your risk. There's a lot of ways to do things.
Hedge it off, sure. Sure. Again, options. You got options. So does that help, guys? Does that shed any light for you, or any light bulbs kind of going off of, oh, okay, that makes sense now? Because every time I tried to flip over and check out those spreads and try those spreads, I always seemed to not be getting $1 a tick like they said I would. And you can kind of see why now, that you probably weren't choosing your spread based on your strategy, or based on your expected move of the market, or based on where the underlying was. You were simply choosing your spread due to that low risk number. Anybody guilty of that? Any show of hands and say, ah, been there, done that, makes sense now? Okay. And we've talked about in some you know, previous webinars that are there in the recordings, and we'll be talking some more about, you know, what example, you know, what market conditions. We'll dig into that a little more of, you know, why to choose those near the market spreads to mimic the market. You know, if you're only expecting a, you know, 15, 20, 30 tick move, you want to mimic that market as close as possible. Okay. If you're expecting a big explosive move, then you might look at those lower risk spreads because you're expecting that move and you've got time for it to move in your favor. But it kind of goes back to what we always talk about, you know, about the ABCs and the 1, 2, 3s of being able to, you know your strategy and system, know those rules, but also, you know to read the market. What market condition are you in? What are your expectations? Okay. And kind of putting all those pieces together and having more than one, you know, more than one club in your bag there, more than one tool for the job. Okay. Any questions on that basic concept there of making sure to really pay attention to not just your risk, but what is the price compared to the indicative price? Any questions on that there? All right, well, good. I hope this kind of helps shed some light, at least that basic concept. Like I said, we'll dig in a little bit more in some upcoming webinars on some different strategies and systems and some ways to apply that. Okay, you just have to keep in mind when it comes to spreads, don't think like a binary trader. It's not all or nothing, all right? That max risk is more about, planned, defined risk, and doing, what is it we always say, Darrell? To do what the chart tells you to do. If your strategy or system is telling you to exit, then you can exit, okay?
Exactly.
So it's always about doing what the chart tells you to do. So once again, guys, hop on over to nadex.com and you can go right here to a Learning Center, go to Webinars, On Demand, and find us right here, Apex Investing. You can go through and, get familiar with some of the basics here and go through, some of those top mistakes and some of those different strategies. Darrell mentioned, hey, not only can you exit, but, you can also add on another spread to help hedge you off. You can learn a little bit more about that in that webinar here as well. And some different ways to know, hey, in this market condition, should I trade a binary or should I trade a spread? Which one is better and why? Okay, kind of helping you to learn to think outside of the box. And, something I say all the time is, some people tell me, hey, well, I'm a Nadex binary trader. Someone else says, oh, I'm a Nadex spread trader. I only trade those. Well, we like to say we trade Nadex. We trade. Okay, don't limit yourself. Different market conditions and different setups. A binary might be better. A spread might be better. Why limit your what? What does Darrell keep saying? Options. Don't limit your options. Learn both and learn how to read the markets to see which one is best for you there. Okay, so I'm going to let us finish off here with Darrell, just kind of giving you an invite to come on over and see us and ask us any questions you might have.
Yeah, hop on over. If you're wanting to learn and you're like, hey, this is good, but I feel like I need some more. I need to, John's talking about learning to read the markets and learning the different ways to use the spreads or trade the binaries or even other contracts. Visit us over at apexinvesting.com. We have a ton of free education. Literally step-by-step training courses for binaries and spreads. We teach you strategies, we teach you systems, we have news calendars, we have a binary and spread scanner, which makes it a little easier to figure out some of these things, and that's free as well. We have free deviation levels. We teach you how to get free charting platforms and underlying data like the futures data and the forex data. And again, we have a free basic membership. It gives you access to the education and the scanner and the calendars and the deviation levels. And, we have a forum there for you where you can come in and ask questions. And we also have a live chat where you can submit a help desk if you, any kind of, questions that you have, and we'll be happy to help you. That's just a quick screenshot. I know it didn't make a lot of sense yet, but it's a way to get all the information you need really quick to make it easy to trade, the binaries. And, that's, like I said, it's absolutely free. And then it does all the calculations for you. We also have one for the spreads. So it lets you see how far away. So instead of a minus, like the indicative and the price, it'll actually show you the proximity, that difference between them. So, check that out. And we have tutorials on how to use it. And you can take those. Again, over at apexinvesting.com. And I just want to say thank you very much. And we will see you over, on the next webinar. Make sure you schedule that. And we'll see you on the website at apexinvesting.com and nadex.com.
All right, guys. Thank you so much for your time today. I hope you have a great rest of your week and a great weekend. We'll see you on the next webinar. Thank you so much. Have a great one. Goodbye.